Thanks, everyone. Greetings to the online audience and welcome to everybody that's gathered here today at the Exploratorium in San Francisco. My name is Scott Atkinson. I'm a Johns Hopkins alum. I recently graduated with my Master's of Science in Environmental Science and Policy, and so all the fellow ecologists in the audience, hello. We're really excited to be kicking off the 5th episode in our Business of Saving the Planet series. After this, hopefully you all will take a look at some of our earlier panels that we've done. Before we get into talking about impact investing in ESG with Lila, Priya, and Michael, obviously it would be helpful to get to know them a little bit better. And I've asked Katie DeHaas, who leads executive recruiting at Celonis, to share with us a little bit about our panelists and their backgrounds.
Thank
Katie?
you, Scott. Yeah, I'll jump in, get right into the bios so we don't waste time. So I'll start with Lila. Lila joined Generation Investment Management in 2004 as a partner and as the head of growth equity strategy. Prior to joining Generation, Lila was the director of finance and development at Volunteer Match. Previously, she was a Fulbright Fellow in southern Chile, where she worked on community-based forestry and conservation projects. Lila currently serves as a board director at Nature's Find and as a board observer at Cibo Technologies, Optoro, and Pivot Bio. She's on the board of advisors at Columbia University's Mailman School of Public Health and is a young global leader of the World Economic Forum. Lila received a bachelor's in English language and literature from Stanford University and an MBA from London Business School. Priya Prasad Bowe, I'll go next. Priya is the head of ESG at Oaktree Capital Management and focuses on the integration of ESG considerations into the investment process. She's also co-chair of Oaktree's ESG Governance Committee. Previously, Priya was a credit product specialist focused on private and multi-asset credit at the firm. She joined Oaktree in 2019 from Citadel Securities, where she was head of fixed income derivative sales and strategy. She spent the previous 8 years at Morgan Stanley in their interest rate sales division, as well as in corporate bond and equity securities lending. Priya earned an MBA from Columbia University and a bachelor's in economics from Yale University. Next, we have Michael O'Leary. Michael is a managing director at Engine No. 1, where he guides the firm's view on impact and active ownership of companies held across Engine No. 1's funds. Before joining Engine No. 1, Michael worked at Bain Capital, where he was founding member of the firm's Social Impact Fund, an investor focused on consumer, technology, and industrials for the firm's private equity funds. He is the author of Accountable, The Rise of Citizen Capitalism, and his writing has been featured by the Aspen Institute, Bloomberg, Financial Times, Fortune, the London School of Economics, Vox, the World Economic Forum, among many others. Michael received a bachelor in philosophy from Harvard and an MBA from Stanford Graduate School of Business. Last but not least, Scott Atkinson serves as managing partner and co-head of Heidrick's Global Sustainability Office, where he places chief executives, board of directors, and senior leaders within companies and organizations that focus on advancing environmental and social impact initiatives across the globe. Recently, he has had the opportunity to work with clients such as Just Climate, Impossible Foods, Indigo Agriculture, the Jane Goodall Institute, Kite Hill, National Geographic Society, Planet Labs, and Virgin Galactic, among many others. And with that, I will hand it to all of you.
Thanks, Katie. Wow, I mean, I'm thoroughly excited about this group, not only because of the topic, but if you go around and talk to people in the industry, you'll know very quickly that Michael, Priya, and Lila reputationally are incredibly well thought of executives. And so before we go any further, I just want to thank you again for coming and joining with us today. I know you all have very busy lives. And Priya, specifically, I want to thank James, your husband, because it's James's birthday, and so we've disrupted birthday plans for you, so thank you. Really quickly, before we get into this, I've been waiting for a very long time to have this conversation. Part of my journey with sustainability began with thinking about, wow, I'm starting to see significant changes in 4 different categories, one being around consumers and seeing consumers have tools at their disposal and to align their values with their purchasing behaviors. And so it's been really interesting for us to see better for you foods, other categories around sustainability being shaped by consumers. Also, it's been very interesting for us to see how employees are now talking more openly about their desire to marry what they want to do, not only professionally but personally, with an ethos and a culture that aligns with many times with climate and environmental and social impact initiatives. So we're also seeing it from the employee base, ESG and sustainability being pushed by the next gen of leaders. That's all of you in the audience. Thirdly, we can talk about policy as well. And then fourth, which brings us to the panel, it's been notable to see over the last couple of years a significant reallocation of capital in and around ESG, the impact category. And so with that, we're looking forward to diving more into ESG and impact. And Lila, I'd love to start with you. If you could just tell us a little bit about your firm. What do you do within your firm? And we won't be bashful about jumping in with questions as we have them.
Perfect. Thank you, and I'm really excited to be here. For those who aren't in the room, it's a kind of beautiful, cloudy, rainy, moist day in San Francisco, which we need. And for the folks in the room, thanks for coming here. And for those online, excited to see you. I think I'm looking at you, although we're going to be talking to each other on each side. So Generation Investment Management, for those who aren't familiar, is a dedicated sustainable investment firm that was set up in 2004 by a group of partners, including former Vice President Al Gore, who's our chairman, David Blood, who formerly headed up Goldman's asset management business, and a set of other founding partners. That from the beginning, and this was somewhat radical back in the early 2000s, put sustainability at the core of an investment process because we thought that was the very best way to deliver performance for our clients. So today, Generation manages upwards of $35 billion of assets across public equities and private equities, and I spend my day hours on the private side of the platform focused on our Sustainable Solutions Fund platform. So here, we're really focused on driving system-positive businesses across planetary health, people health, financial inclusion, and that means we're doing deep research, we're trying to meet the very best companies, and then support them with growth capital as they expand their products and services to address one of those pillars as part of this transition to a more sustainable future. So that's the headline, and then happy to take it whatever direction
Could you
like.
go a little bit deeper into those three pillars?
Yes. So if we think about where we see the biggest economic opportunity, sometimes we call this a sustainability revolution. We see this across many, many sectors, if not all. And actually something Generation publishes for the public domain, which folks can find on our website, is our annual Sustainability Trends Report, which takes all of the charts and figures that we see in a year, 194 of them, I think, in this year's fifth report, and puts them together across sectors, whether it's finance, healthcare, energy, industrials, and so on, to tell the story of what's taking place across the economy. If you think very broadly about planetary health, this would include net zero solutions in mobility, food and ag, energy, industrials. If you think about people health, this would include driving better health outcomes and a lower cost, more efficient healthcare system. And then financial inclusion is broadening access and creating a more equitable future of work. So those would be the three areas. And what my favorite point to make about all of them is this is systems thinking, because so many of our companies actually hit 1, 2, 3 of those pillars. And again, I actually think if you don't take a holistic systems view of investment, which is what we think about as integrating sustainability across everything that you do, you will miss value, and therefore, in our view, you will not be the best allocators of capital. And I think we all probably share that kind of core philosophy and belief. It definitely plays through a Generation over almost kind of 18 years now.
Yeah, and Generations always has had a focus on impact as a core focus of the investment process and the ethos of the firm, which is, and Priya, I want to bring you into this, a little bit different than, you work at Oaktree, which is more of a traditional, large, and highly respected private equity firm. I'd love for you to share a little bit about your firm and also a little bit about what you do there as well.
Absolutely. Yeah, definitely a very different journey from what Lila was describing about Generation, but we're a $150 billion, more or less, asset manager. We focus on alternatives, mostly in credit, but also real estate, public equities, and private equity. So really runs the gamut, and we are a bottom-up fundamental analysis-based shop. So we really try to dig deep into companies, understand what makes them tick. And I think sustainability really fits nicely there, because when you think about long-term value being repaid as a creditor, you really pull in these ideas of how long is that company going to be operating, how well covered will we be on our investment. Sustainability really fits nicely there. In terms of what we've been doing more recently, we've been trying to more systematically bring that into our investment processes, even where we aren't operating impact funds, not specifically trying to advance a social or environmental goal, but understanding that that is a core way that we need to think about how we invest on a day-to-day basis. So it's been quite interesting because the standards are evolving. A lot of different clients have different ideas about to what degree sustainability should be incorporated into what we call ESG integrated funds rather than impact funds. So it's been quite an interesting journey. It's certainly not over yet.
And Michael, I also want to bring you into the conversation. Can you tell us a little bit about engine number one as well? Because there are parts here that I know you share, but I think also many people in the audience are just curious about what engine number one does and how you fit into the firm.
I think one underlying thesis I think all three of our firms share now is this idea that social and environmental issues are economic issues. And I think this is something that Generation realized before many other investors did. And I think if you look at the growth curve now of assets being allocated to ESG strategies, impact strategies, in many ways we're on this exponential growth curve, but it's still a small portion of the total assets under management globally. And so in many ways, this idea that focusing on sustainability, focusing on climate, or focusing on racial equity or workforce issues is the right way to think about building long-term shareholder value. In some ways, that's still contrarian, which is surprising to say given the broader lip service that oftentimes is now getting paid to the sustainable investing world. Where engine number one plays is a public equity investor for the most part. We are focused on these connections between the impact companies have and the value those companies are then able to create for shareholders over the long term. All under this thesis that if you're focused on a long enough time horizon, you can't be a good allocator of capital, a good active owner, unless you're spending enough time thinking about the impact those companies have in a very deliberate, quantitative way. And I think that active owner part is maybe what sets us apart from some others in the space. We take as a kind of underlying hypothesis that if we want to have a positive impact in public equities, large public companies, it has to be through what we do differently as an owner, through the way we vote our shares, the way we engage with companies, all the way up to and including running activist campaigns, nominating new slates of directors, as we did at ExxonMobil over the spring. That is underlying thesis to what we do. It's, I think, different than some other philosophies around ESG, but in many ways complementary. This idea that if all of us are focused on how does ESG connect to value, that there's a real role for some investors to play who are focused on helping to influence those companies to reorient their businesses, their operations, their strategies, their leadership to focus more on it.
So this is a question for all three of you. And the question is, why the acceleration in and around ESG and sustainability? And how has it affected the creation of engine number one? How has it affected how ESG is being integrated in Oaktree? And Lila, I hate to put you on the spot, but also you've been in this space for a very long period of time. So I'm also curious about what you've seen along the evolution in this category, and why now we're seeing an acceleration potentially.
There are many reasons. You started up front with the 4 pressure points or kind of accelerants, whether it was consumer demand, you're talking about the finance community, you're talking about fundamental cost down curves. I think it's really important just to call out that there's been some real advances on the technological front that have brought down the costs of better for you, better for the environment solutions, whether it's in renewables, it's in building efficiency, it's in battery power and storage, it's in compute power, it's in genome sequencing, it's in gene edit. I mean, just you name it. There's plenty of great charts out there to look at those cost down curves. So that's, again, disruption and technological innovation that opens up for the first time, I'd say, probably in the past, it's been going on over the past 10 to 15 years. the ability to not have to trade off value for values or accepting a suboptimal product. I do always give the example of Seventh Generation, which was a company that we invested in a while ago now. But this was a company that had been around for 27 years when we invested in it. It had cemented real leadership on bio-based, non-toxic household products. It had an extraordinary brand. But one of their favorite quotes in the early days was that their customers would say, "We love this brand so much that we use the products even though they don't work." Like there was just a lot of evangelism, but actually if you needed to get really clean, clothing and your dishes clean and your, heaven forbid, your child wearing diapers that you'd want to have them work, there was actually quite of a performance gap. And what was starting to happen, this is now kind of rolling back the clock to the 2010 to kind of 13, 14 period, is that product improvement, again, bio-based inputs for their detergents and surfactants. They had innovation in packaging design. They had innovations in adhesives and all the componentry that would make these products finally be as good as Tide or Dawn or Pampers. And that was when you started to see the real market adoption. It moved from the Whole Foods channel into the mainstream, mass market channel. And that was that kind of inflection curve that we were, identifying and then catching as it moved. Now, rinse, repeat, you can pick every sector of the economy where we started to see the lineup, not just technological, but consumer demand, policy frameworks and shifts, and then the financing layer that you talked about. So those are some of the kind of observations of how things are moving for a bunch of reasons that are delivering better products and services, and I think that's the key.
I'm curious because I know your approach is quite research intensive, and that the example that you just gave was one where there might be operational or product improvements needed. But when you are making decisions on which investments to pursue and not, how do you weigh the impact with the business outcomes? Yeah. I mean, obvious the answer is probably both, but I'm just curious how you measure and lean into that process.
So we think about companies along two lines, and I bet this is something that we share different frameworks, but ultimately we're...
You know where I'm going with down the line with the panel.
Yeah,
yes,
which
exactly.
is and I think actually this is really important for people who are starting their career or looking at careers in finance and thinking about how sustainability drives performance, is that, very simply look at the what and the how. So sustainability and what. What does a company sell? Products and services, whether it's a software, it's a widget, it's a service. As that company sells more of those, what is the contribution toward the Sustainable Development Goals? How can we measure that? And ultimately, if it's an environmental solution, you can do life cycle assessment. If it's a financial inclusion product, you can do benchmarking and you can look at social outcomes. The toolkit is robust now, such that you can understand how a company sells more products and services, what will be the contribution towards a more sustainable future. And candidly, if someone isn't asking that question in their investment activity, what in the world are we doing, right? Like, I don't understand how pensioners should be giving their money to institutions who would allocate capital and not know the answer to that question over time. It's just, fundamentally an inhabitable planet would make sense for all pensioners and all of us as well. Secondly, how does a company operate? Which is really the engine room behind the products and services. It's the culture, it's how they address diversity and inclusion and drive an inclusive organization. It's the governance structures, it's the board, it's the stakeholder engagement, it's the way in which they manage their supply chain, and all of that has to be equally sustainable, because otherwise they won't be able to continually churn out their products and services. So I think if you kind of distill it to that, we track the what and the how. We use a whole bunch of tools in a toolkit that are available to our finance ecosystem, whether it's the impact management project, whether it's using the Sustainability Accounting Standards Board, and you could add 20 other different toolkits that would be available to measure the what and the how.
Yeah, Michael, is that different, similar to how engine number one approaches the investment process? I know you play a big role in that, so I'm curious.
I think there's this myth, oftentimes from traditional finance folks, the first time they're interacting with the ESG or impact investing world, this myth of a trade-off. They'll say, we've spent our whole careers maximizing a single variable, risk-adjusted return, And now you're adding in all these other constraints, all these other goals, social and environmental. That must be coming out of my pocket somehow. And you can think of a overly simplistic example of a income statement, and they say, well, if you're going to pay your workers more, that's great for workers. But that's going to go from cash going to net income, and it's going to go up to SG&A, right? And I think one thing that misunderstands, and this gets to the way engine number one thinks about it, it misunderstands that if you look at these things over the right time horizon, these aren't costs or trade-offs so much as they are investments. And just as R&D is a cost today, the question is it going to pay off in the future? And it's the same thing by focusing on, are we creating products that are meeting customers where demand is going? I think Seventh Generation is a great example of a company that saw the direction of travel and got there before others did. And in many ways, some of the other bigger competitors are still playing catch up. It's the same thing with where employee demand is. I think we're sitting in San Francisco right now. San Francisco is a great example of an economy that is in many ways defined by its war for talent. And the way you win that war for talent is partly through comp and recruiting, is partly through, do we have a deeper mission that employees feel connected to? Are we able to give our employees a sense that they are serving a purpose greater than maximizing shareholder profit? I think that's where what we try to do, engine number one, our framework is to say, it's important for us to focus on the same financial, operational factors that everyone, all good investors focus on, but we should take a broader aperture, a more expanded view of what are the other ways that companies create and destroy value for their stakeholders. Let's look at the carbon emissions they put out in the atmosphere. Let's look at the wages they pay, the diversity of their workforce. Let's look at the healthiness of their products. And we think if we can add up and subtract all those different values that those companies are creating, that will just make us better investors, better active owners, better able to understand how these companies are going to be affected by a world that's rapidly trying to decarbonize, or by a world that's trying to reckon with racial equity. In many ways, I think to look at anything more narrow is to ignore some of the core drivers of company success today.
It's got to be really hard to measure all that and capture it, right? And incorporate. And Priya, I'm curious about how you all integrate ESG into Oaktree as well. I'll pause there.
Yeah, I think there's so much. I have so much to respond to from what folks are saying. I think, Michael, you're absolutely right. A lot of times people they've been investing a certain way for a certain number of years, and they've been reasonably successful, and they say, if this is so financially material, how come I wasn't doing it before and still did fine? But I think there are things that are changing in terms of consumer preferences, in terms of, particularly for human capital intensive businesses, where you essentially take financial capital, work with your human capital to turn that into revenue. Super simplistic. So folks, I think, oftentimes have a harder time with the social factors in ESG, because they're thinking, well, how does that translate to the bottom line? And the reality is that not everything always shows up in the financial statements in the next quarter. Sometimes it's about, if we're talking about long-term sustainability, then we're looking for factors that help folks think about if most of my business success relies on the intellectual property that my workers generate, how do I retain them? How do I keep them interested? How do I treat them well? And that's something that, of course, with today's labor market is super top of mind, even for companies that don't necessarily have most of their business success attributable to their intellectual property. So I think in terms of measurement, it can be challenging. I think sometimes you're taking qualitative assessments and trying to map that to something quantitative can be really, really hard and maybe give a false sense of precision. But what we're trying to do is, where it's quantifiable, certainly there are numbers that we can look at and compare, especially across an industry or across a geography. But generally speaking, we're trying to think about ESG as something that points us to risks and opportunities throughout the investment life cycle. So in selection of investments, as those investments make their way into our portfolio, how are we monitoring, actively engaging with management, and where we have control over a company, thinking about adding value through influencing management and their operations as we prepare for exit. I mean, those are really becoming non-negotiable for us and for our beneficiaries. fiduciaries who really want to make sure that we're aligned with their values and the values of their pensioners who hope to live a long time and benefit from the world that we create through the capital allocation that we're responsible for today.
And can I just add in?
Absolutely.
This is, there's a lot happening really quickly now. So what is true, while we've kind of been, generation set up a while ago, and it was always clear to us that this was the best way to allocate capital. Now I'd say you're getting validation points. Not that this is that was a unique insight, but certainly now there's more folks arriving at that insight, and that's wonderful. It's extraordinary. And commitments coming out of the COP process in Glasgow this last week and this week, 130 trillion coming from the finance community to commit to net zero by 2050, if not earlier. You have the announcement of the International Sustainability Standards Board, ISSB, which, if you want to geek out, there's a lot of acronyms in this ecosystem, but it's critical that we start to get common frameworks for kind of ESG measurement, and I think this is a very big step of consolidation to say now there is critical mass. We're actually moving towards a regulated requirement for disclosure, and I think that is going to bring everyone along. So that momentum is probably not soon enough. I think we need to kind of now ride this very quickly and move from commitments to actions off the back of it, and getting large capital providers on disclosure, measurement, and making this just best-in-class hygiene for investing.
Yeah, there's so much greenwashing out there, and people making things sound sustainable more so than they really are, and that's a threat for people who want to live in a temperate world, in 15, 20 years. And I think those standards, that clarity around measurement, I think that will be a really important keystone into making all of this real.
Yeah, I mean, and on greenwashing, we see it not on the portco side, we see it on the fund side. It's all over the place, and it's fun being with the three of you, knowing that there's real authenticity around what you all are doing in ESG and impact. Really quick, we're going to switch to some personal stuff because we'd love to hear about how the heck you got into what you're doing today. But really quickly to the audience, we'd love and encourage you to send us some questions that we can ask our panelists. Feel free to do. And also in the audience, if you have a question, and if you do, if you wouldn't mind just announcing who you are, that'd be great. And why don't we go to that, to the audience real quick.
I'm going to take my mask off if that's okay. This is excellent. Thank you guys for the discussion. So a lot of what we're talking about around the regulated disclosure and ESG is really about measuring negative impact, and yet you all are talking about, and certainly system positive, be good to hear more about that, like how are we actually going to measure the positive impact from some of these companies, because that's where I think ESG turns into something a little bit more exciting, personally.
So I'll just, for full disclosure, that is my sister-in-law who just asked the question, and who heads up Sustainability Autodesk. And we think about ESG is hygiene. To me, this is like risks and opportunities work that every single investor should do if they're taking their fiduciary responsibility appropriately. On top of that layer of impact, as these companies grow, what is the contribution towards a more sustainable future gets at the upside. And I actually do think this is where economic opportunity comes in. And having more common frameworks to talk about emissions reduction, science-based targets, the specific laddering up towards a net zero future for companies, equally on the social and inclusion measurements, diversity, equity, inclusion at all layers of an organization, starting to think about kind of indicators of positive outcomes. These are outcomes towards longer term impacts. As we all know, it's not the ultimate impact yet, but that's where I actually think we could unleash the competitive nature of capitalism to do its best job. So that's what I get particularly excited about.
I would say, there's a lot of acronyms in this field. There's also a lot of frameworks. Some very thoughtful. One of the leaders of TPG Rise is in the room. I think their impact multiple of money where they try and measure the positive impact that comes from an investment, gets exactly at this question. I think about, there's a company we're invested in that does advanced stroke care, where every time their product is used versus the alternative standard of care, it's both lower system-wide costs and improved outcomes for the individual. Now, if you look at their ESG score, the advanced stroke care company, their ESG score is literally half of that of Altria, the parent company of Philip Morris, makes Marlboro cigarettes, right? And it's this very stark reminder that we're still in the early days of defining what ESG means, what a good or bad ESG stock should signify. I think a lot of investors retail investors who invest in ESG funds are oftentimes surprised to see that the top 5 holdings of many of the largest ESG funds are Facebook, Amazon, Google, the same companies being carted in front of Congress for undermining democracy or whatever it might be. And so I think we're still at this stage where we are in many ways hampered by the data. If you're trying to create a ratings company, you have to find standards that will work for every single company in your ratings universe, which means you're going to have a hard time trying to assess the health impact of every single company, because that'd be bespoke analysis. What you can measure is, do they have a certain policy in place, or do they have a certain process in place? I think greater disclosure, transparency, standards from the SEC, others are going to help with this. But ultimately, a lot of it's going to stay at the fundamental investor point of view when they're building out their model and trying to understand what are the drivers of this company, focusing on those positive, do my products make people's lives better? Are my operations not just net zero, but actually restoring the environment, restoring the ecosystem? I think that's where there's going to be continued to be an advantage for fundamental investors who focus on these issues.
I think the other key thing to think about is improvement over time. So maybe you invest in a company that doesn't have perfect practices, but you're able to work with that management team and track those outcomes, whether they be qualitative or quantitative, and think about what they really mean. So a KPI, key performance indicator, might look a little bit different for each company. And even though I love numbers don't always tell the story. So what does board diversity look like? We want to see more diversity along certain axes, but are those people being included in the influential committees? How frequently is their expertise being called upon? That kind of involvement, that is qualitative as well. So I think as we keep looking for more quantitative improvement, I think that's where kind of this fundamental analysis component comes in as well.
Knowing that many individuals in our audience, and actually Matt, do you have a question?
Yeah, now's a good time.
It's fantastic.
Hi, thanks you all. It's great to see the dynamics and how you all approach these investing topics very differently. I'm really curious about the impact of policy and specifically carbon taxes. I mean, it's unclear if this will ever happen in the U.S., but do you find this is necessary to get us under 1.5C? And how do you guys think about how that impacts or changes your business model? I mean, a lot of what you guys are talking about is disclosure and smart investors, but this is a little bit of a harder line and a bit of a stronger carrot and stick, I would say, for companies to take carbon emissions seriously. So how do you think about something like that, and how necessary is it for us to get there?
It would be the most efficient way to send a price signal on externalities. And so I think the wave the magic wand answer I always give and have given forever is a price on carbon, a global price on carbon. However, in absence of political will to make that happen, which is not zero, but is certainly not 100%, I think we are going to ride commitments that turn into actions that turn into consequences. And I think we haven't yet hit the era of consequences, and eventually Mother Earth will be the consequence, and we see that. And I think that there would be real leadership on the policy side if we could put a price on carbon that was appropriately high. If I just think about now the voluntary markets for pockets of the economy like agriculture, right? We know what regenerative practices look like. It is not voodoo science. It is knowable. It's a set of activities, includes some technology. There's monitoring, reporting, and verification that is quality today. There's the benefit of cost down curves from satellite observations and sensor probes in the soil. Like all of this should make it such that we reward farmers and growers for making decisions that reduce emissions and or store carbon because of the practices in building up soil carbon. What's the forcing function? How do you get that to take place? Many big CPG companies are taking leadership to say we're going to do this called insetting, which is taking care of their supply chain. Other people are going to talk about it as offsetting. At the end of the day, it's all of the above. And this is in advance of having just a brute price signal, which says, you're going to have to pass this cost through your supply chain. So my hunch is, as voters, we should all be calling up our politicians and advocating for carbon taxes. But let's get the infrastructure bill fully signed first.
I spent a very little bit of time in Democratic politics, and oftentimes, when I talk with folks who I'd worked with and talk about what I do now, and they say, I agree with you on the problem set, but we already have a solution for this, and it's called the federal government, and here's what we need to enact to solve everything you're pointing at. And in fact, Tariq Fancy, I don't know if any of you are familiar with him, he was the CIO for sustainable investing at BlackRock, has since become quite cynical on the space of sustainable investing, calls it a deadly distraction in combating climate change, points to sort of government response to COVID as a better model rather than what we're currently doing. And I think what it misses is that it is a false choice to say we need to combat climate change through government or through the private sector or through philanthropy for that matter as well. This is a sort of all-encompassing crisis that requires solutions to come from all spaces. And I think maybe a better corollary to look at would be the labor markets, that very clearly federal government has a role in minimum wages or protecting the right to organize. And very clearly companies play the predominant role in actually creating those jobs and competing for talent. You see it right now in the tight labor markets as companies are raising wages, increasing benefits, flexible scheduling, education credits as they're trying to recruit better talent. And I look at electric vehicles right now as a very hopeful sign, where you've got, in the absence of a carbon tax, you've got particular states and countries who are saying, we're going to outlaw sales of internal combustion engines by 2035. You've got companies who are saying we are going to transition our business entirely. We're investors in General Motors. Mary Barra, the CEO there, I think is really leading and saying we're going to transition our business entirely from 98% internal combustion engines to 100% electric vehicles in the next 15 years. It will only be possible if the government also invests in infrastructure. And it's only be possible if we as consumers buy the cars that we're making. But that is the kind of cross-sector, public, private, consumers, philanthropists that's going to take to make any real movement on something as large as the climate crisis.
And Matt, I love the question because it's a good reminder that whilst we have a panelist that's all coming from financial services, policymakers are critically a part of the conversation. Scientists are critically important part of this conversation. There's a whole broad swath of stakeholders that are on the journey in terms of reshaping what the economy looks like. And actually, I'd love to hear a little bit on how you incorporate or don't scientists, and again, knowing that our audience, many of them are scientists, but how you incorporate scientists or criteria that's science-based into either the investment process, the measuring process. It's an open-ended question, but would just love to hear, because I'm sure there are folks that are scratching their head, I'm not going to get involved in being an investment professional or heading up ESG, but I know, but I do have a different set of skill sets that might be complementary, applicable, and help accelerate some of the things that we're talking about.
I think, for us, what we've seen is that many of our analysts have sort of become a lot smarter about climate and technological feasibility in their sectors in the last 5-10 years, because they've had to really get smarter around the debate around what's feasible and the technologies that are available. So I think we currently don't necessarily have sort of an on-staff climate scientist, but that's expertise that we need to pull externally into the firm, because it is so critical, and it's amazing how much disagreement there is about basic facts out there in the investment world. So I definitely see this desire, especially from our analysts who are so focused on the fundamentals of companies, how how products are actually made, how things get from A to B, where they need to draw on real experts in those fields. So I think we'll probably be more and more reliant on those external experts with that kind of hard quantitative scientific knowledge.
Yeah. We organize our work, we do research up front. We call them roadmaps. It's our kind of mapping exercise to understand a 360-degree view of any sector and then companies within the sector. As a firm, I think Generation's done 300 of these roadmaps. Probably 150 of them have been done in the growth team, which is our private equity platform. And part of that is talking to the incumbent big companies, the disruptors, and the companies that we might back who are driving the solutions, but also the academics, the scientists, the nonprofit community, the regulators, that you need to get that perspective. And so that's Generation from the very beginning. We actually, before we managed assets at all, we set out with a kind of a systems framework for thematic research, and we rolled through topics including climate change, pandemics, poverty, water scarcity, urbanization, demographic shifts. So this is back in 2004, 2005, and looking at how did we build a network of people who could advise us on these topics. It's very lucky that we have one of the leading experts on climate within Generation, so access to that scientific community has always been available. But roll forward in agriculture, because it's one of my passion areas, talking about soil science. So we have leaders like Dr. Ratan Lal, who run the World Food Prize, who has helped us think about the role of soils in both carbon sequestration as well as delivering healthier, better food system solutions. In our roundtables, we host these summits, which are these deep dives, bringing together our real community around a topic: future of supply chain, future of upskilling and reskilling, future of food, future of cities, you name it, future mobility, and that we'll always have that perspective in the room. So I just think it is critical, and I really, really, really think there is information and insight that comes from these communities. And then second, I think scientists are some of the best investors. On our team, we have former chemists, former physicists, people who are extraordinary thinkers, and they see things that others don't. And therefore, as part of a diverse team, and we have a pretty high kind of diversity focus at both a Generation within our own growth team, which is about 14 people, actually diverse backgrounds help make better decisions. As long as you create the process that takes advantage of those diverse backgrounds and includes their voices. So doing things like voting up and down on Slido when people are presenting, to let everyone, anonymously or not, enter questions, so that they don't sit there in the corner and say, oh, I had this question, but it didn't seem like maybe I wasn't senior enough, or it didn't seem like there was a pause, so I couldn't get my question in. Using tools to capture those perspectives as well. So it's a really great role for scientists in investment.
Michael, anything to add?
Say, we look at the opportunity now for the world to reach net zero by 2050, to limit planetary warming to 1.5 degrees Celsius. We're going to have to fundamentally change the way we grow food, the way we create energy, the way we move people and goods, the way we build our cities. A lot of these are scientific questions. A lot of the stage right now of the sorts of companies and solutions that are going to be required for us to, for example, make green concrete or green steel, or be able to power jet engines in a cleaner, more efficient way. They're scientific questions. And engine number one is a new firm. We're less than a year old. We have a chief science officer. I think because of this idea that so much of understanding and navigating what used to be a sector, climate investing used to be a sector, and we now think is kind of a defining driver of our economy over the coming decades. That requires a level of expertise that I think goes beyond what maybe a traditional financial firm would usually have, and I think increasingly all financial firms are recognizing that they need.
Before we go to the audience Q&A, just a couple rapid fire questions, but it can't be rapid fire because they're personal. And this is probably my favorite question, but when did it click for each of you that this is my calling professionally? I need to do something aligned around ESG or impact investing. When was that? Was there a moment, a handful of moments? I'm just curious.
I think for me, I can and pay credit to the former governor of Massachusetts, Deval Patrick, who, when he left office, he joined our firm. He joined Bain Capital to launch an impact fund. He had done some innovation around social impact bonds as governor, so this kind of unique corner of the impact investing world, and had joined Bain Capital to launch kind of an institutional scale impact fund there. And I think his very strong view that we are oftentimes led to false choices in finance as in many pursuits, and this recognition that both you can create value by focusing on impact, not just be non-concessionary or market rate. These are terms the impact world uses a lot, but you can actually create alpha, generate alpha, outsized performance by focusing on impact. I think it was in some ways an eye-opener, part of the process of building that fund and looking at trying to find the attribution of what drove success at different portfolio companies over time, and seeing how often it was companies that were focused on these issues historically. And then I think also recognizing how much can be done through the power of active ownership. That it is one thing to align your capital with companies that are doing great things, and you can be proud to have your money with. And additionally, there's ways of investing that I can actually have kind of a trajectory shifting impact on companies, small or large. And that ultimately investing entails ownership. Ownership entails a certain amount of responsibility and accountability. And I think that's something that is a through line from Bain Capital through engine number one, and I think where a lot of the field is headed.
I started off not in an ESG role. I'm probably the newest person to the impact sustainability world on the panel, but I was in sort of a business development role.
I think you have me beat, Priya, so I might do that.
I was in a business development role, and what we started to see more and more from our clients was that they were demanding things that we didn't have systematic processes around, and that we needed to present ourselves better. So it wasn't just we aren't doing anything and we need to do everything. It wasn't just that we need to say more without doing anything on the back end. We needed a combination of both, kind of being able to present ourselves well, but being very faithful to our high sincerity, high credibility approach to, and contrarian approach to investing. So I think, for me, the exciting part was seeing how genuine and excited some of our limited partners were about making real change, about aligning with their beneficiaries, making sure their dollars were put to work in a way that matched with their values, and then saying, yes, we can rise to meet that occasion, and here's how we're going to do it. And that has a little bit of, kind of the more traditional investment world, but also a little bit more of this newer sustainability lens where, we are being expected to have sort of corporate citizenship. Employees really appreciate it as well, to know that they're part of something that has a positive impact or is improving impact over time. I think that's what gets me really excited about working in this field.
So for me, my penny dropping moment was as an intern at a firm called Generation that had 0 assets under management and was just starting, because that's when I met this firm, and it was I entered finance at age 29. So I had come out of business school, so I guess I was at least somewhat prepared. But before that, I worked in self-taught finance over here on Goff at a nonprofit called Volunteer Match. Before that, I was doing sustainable forestry in southern Chile with a Fulbright fellowship, and before that, I was an English major. So if you ever need like confidence that the circuitous journey lands you sometimes in really interesting places, it was my interest in looking for how do we scale impact, and it was following the money ultimately. Like, how do you get impact at scale? And I finally landed at this firm that didn't think I was some sort of esoteric, crazy kind of marginal perspective. And I remember how it felt to be in a room of investment professionals, about 2/3 who came from mainstream finance. So Goldman is a big kind of a former employer for many of my colleagues. Morgan Stanley, there is really top-notch financial investors, alongside people such as myself at the time. Again, I was young, but a former environmental economist, policy and government affairs executives, people who are scientists. I mean, sitting here and saying that we both are responsible for full financial analysis and full sustainability analysis. I had to get trained up as a financial analyst, right? So it was public equities and then private equity. But it was this like space that respected both perspectives. And actually, we use this image of like a double helix from the beginning to say it is actually possible and it is required that everyone has to do both. And I just, like, where, at the time, it was like, where else could you be your full self as someone with a weird background such as mine in finance and actually influence some pretty significant decisions about, scaling investment. And I just remember that feeling. And so that was to me like, okay, this is where I was meant to be. And I've been really, really, really lucky to have that space.
That's great. What's exciting for me being in executive recruiting and the work that I do, I love the word weird backgrounds. Non-traditional backgrounds are many times sought after and what we're targeting on many of the searches that we're working on, whether it be someone making a move onto a team as an investment professional or in some other way to join the firm. And all of you bring such unique blends of experiences. It's great to hear.
But can I say one more thing? It is just as important that people who have had very narrow backgrounds actually arrive at this moment in time as a sustainability thinker. So I have always thought like mainstream firms, even adding layers and understanding and capabilities, it is just as catalytic. So we have to have both. So weird backgrounds, yes, but actually highly skilled professionals doing one thing better than anyone else. If they have this moment of recognizing that sustainability adds value to their decision making, we are starting to, really move the market. I think that's that combination.
It's a great point.
And ultimately, in public equities, you can only ever be influential at a company if you can either explicitly or implicitly convince 49.99% of other shareholders to agree with you. And so you can only really ever have a large impact if you can bring along those other more traditional investors, folks who don't consider themselves sustainability investors or consider themselves ESG investors. If you can bring them along on that journey, that's how you can actually get big companies to shift.
Awesome. Would love to jump to the online audience if there are any good questions.
Yeah, we've got quite a few. Is the mic on? Okay, you guys can hear me. We'll start off with this one, and this is for anyone on the panel. How do ESG investment managers ensure that green investments actually live up to that label? Where do investment professionals get their advice on which investments are truly green or sustainable?
So there's tons of resources. So I guess the question is, if you are, one way to look at this is using tools. I mean, actually, Bloomberg has done a really good job of aggregating a lot of information around ESG now for the mainstream markets, public equities, and it is a little bit more bespoke in private equity. The Carbon Disclosure Project would be one way to look at whether or not a company is measuring its Scope 1, Scope 2, and ideally Scope 3 emissions. Like that is it is not a shortcut because it won't tell you all the information, but if you look and read these disclosures, you could get a sense of how seriously a company takes the commitments, whether or not they have a net zero pledge, whether or not they use science-based targets, whether or not they're doing scenario planning for a variety of outcomes, but specifically R&D and positioning for a 1.5 degree C world. So that would be one of many resource toolkits.
One thing we think about, this is where I think we'll be a little bit different than many other ESG investors, is we as a firm in some ways are an odd firm to call an impact firm or sustainability firm because ExxonMobil is one of the largest positions in our portfolio. And part of what it speaks to is we've got this focus on you should judge an ESG fund or sustainability fund not necessarily by what it holds, but by what it does as an investor. And I think one of the shocking things today, many retail investors don't necessarily recognize that big public companies are run like little democratic republics where the shareholders elect boards, boards appoint CEOs, CEOs run companies, but ultimately we have the power to vote, not just on board elections, but on literally hundreds of shareholder proposals every year on social and environmental issues. Things like, should the company report on human rights in the supply chain or gender pay disparity or climate emissions reporting. And one of the shocking things today is for a lot of these funds, even climate funds or sustainability funds, if you look at their voting record on these sorts of issues, they'll actually vote against 90% of climate proposals. This is Morningstar is doing a lot of research here, but others, As You Sow, Majority Action, Share Action, there's these kind of shareholder advocacy groups that have focused on this issue in the past. That's one area where I'd direct anyone who's thinking about investing in this space or is looking into this space is an increasing focus on judging investors by what they do, the influence that they actually wield, and seeing whether that aligns with 1.5 degree world, whether that aligns with what they're claiming.
It sounds so easy, though, to not have that disconnect, but there's so much complexity when you go into on why. Well, I guess the question is, do you see a day of reckoning coming potentially for some of those funds that are not, I'm struggling to think of the word, but you know what I'm saying.
Well, in 2021, in some ways, was a watershed year. I mean,
Right.
There was a record number of social and environmental proposals put forward at public companies, a record number withdrawn because the company just did what the proposal asked before it even went to a vote, and a record number passed. In 2019, 0 climate-related proposals passed at public companies. This year is something like 11. Now, it's still fewer than 2 in 10 proposals passing, but what 2021 shows is when the spotlight's on, big asset managers are willing to move. For the most part, the big multi-trillion-dollar asset managers have traditionally been some of the most deferential on these sorts of issues. They've not seen it as their place to tell companies how to run their businesses. They've not seen it as their place to kind of put their thumb on the scales of some of these shareholder issues. But as a result, they've also, if you look at the average S&P 500 fund over the last decade, they've voted against 90% of environmental and social proposals. That's shifting now, and I think you'll see it continue to shift. Some of the biggest asset managers, one of the largest, I won't name names, one of the largest literally went from supporting 6% of climate proposals to something like 60% in a single year. They, by 10x, increased their support because investors care now. And competitors are offering competing products, and stakeholder groups are shining the spotlight. So I think we're in this moment of reckoning already, and I think it'll continue to grow, and there'll be some regulatory tailwinds behind it too, as shareholder voting as an issue, I think, becomes more prominent.
Yeah, our limited partners ask for more and more information. I mean, we have a very small public equity business, but in that universe, they ask, how are you voting your proxies? How many did you vote? What were the topics? Please give us all that transparency. Again, it ends up not being as applicable to us because of the composition of our business, but you feel that pressure, and you see that in asset manager, more mainstream asset manager kind of sustainability reports, where they're starting to actually show their work.
Next question. Another one from the audience is, how do institutional investors balance the need for drastic action, COP26 for example, versus profit? Or how much do they drive the trends that may have the most long-term benefit for people and planet versus following ESG trends in the market that may not necessarily have the best outcomes? Or in another way, how much do they trust capitalism to deliver the best results for people and planet? It's a mouthful.
We spend a lot of time thinking about where can we uniquely contribute? Where can we, as an asset manager, uniquely create impact across the world, across the planet, across social issues? And that oftentimes means that we focus on the issues that are most intimately tied to creating economic value for shareholders. Which is not to say that there are other issues that don't matter far more, or other issues that others should not be spending their time on, but it does mean that we, as a long-term investor, I think will be most effective when we focus on issues that can create long-term value. Now, the good news is that is a broad set of social and environmental issues that have not been focused on enough by other investors, by other companies. And so I think that we've got a long way to go until we kind of run out of these win-win scenarios of increasing focus on stakeholders also is benefiting enterprise value for companies. But I think we always try to remind ourselves, at the end of the day, we are investors trying to create long-term value. Our thesis is that the right way to do that is by focusing on social and environmental issues, but that ultimately we're still a capital market participant, and that's where we can have the greatest impact.
Next question. This is a fun one. So for everyone, who has been your mentor and greatest inspiration throughout your career, and why?
I always advise people to take the weight off having one and have many. So number one, so I feel like the people like David Blood and Al Gore as mentors and supporters of my career, absolutely. But looking outside and there's people like Frida Kapor-Klein, who's been really, really helpful to me thinking about the importance of driving inclusive and diverse organizations throughout the analysis of the how a company operates with Kapor Capital. People like Janet McKinley, who was kind of in mainstream finance and then has really looked into small and micro business and extending credit into emerging markets. I mean, these are people who've taught me lessons. So I guess, and I could go on and on. There's, many, many others. But build a constellation as compared to looking to any one or even anyone particularly well known. It actually should be that you look for people who have a certain skill set that could teach you something. That's just some of mine.
I've always had someone in my group at my same company, someone outside my group at my same company, and then someone outside of finance overall. And that served me really well because that first person really knows the situations that you're dealing with. That second person understands the organization, but not, you can maybe speak a little bit more freely about specific situations. And then the third person gives you some bigger picture perspective, helps you get outside of your head and gives you some bigger picture guidance around how things work. You can talk about goals that are not constrained by how your organization is set up. And that has changed over time as I've moved organizations. And I still try to keep in pretty good touch with most folks because there's just so much you can learn. Experience is the greatest teacher, and barring the passage of time, you have to draw from other people for that.
I love that. I wish they taught that at business school. It's a great framework. I would say, Governor Patrick, who I talked about earlier, I think one thing I'd point to that I learned from him when we were launching Bain Capital's Impact Fund, I think there's always a tendency in the finance world to try and come with all the answers or think you have all the answers. And one thing we had done was spent the first year very much on a listening tour, trying to learn from folks like Generation who come long before us, smaller impact funds, spaces, other stakeholders around. I think so much of the stakeholder capitalism movement is being driven forward by shareholders. And one risk of that is that they're making decisions in glass towers and conference rooms that are entirely divorced from the people they're ultimately trying to serve. And so one thing I always try to remember is to keep the voice of the stakeholder close and loud and constantly think about whose voice is not being heard in this meeting or whose voice is not being heard in this decision that should be.
Any questions from the audience? Oh.
One second. As far as some of the reporting that you guys were talking about in the public disclosures, especially for Fortune 500 companies, so CDP, DJSI, now I think the big one is TCFD from Bloomberg. Looking at these reports and these analysis, I think setting the scope 1, scope 2, scope 3 targets, it's really easy for a company to report these things publicly. How deep do you go in with the target, the milestones they're trying to hit, to really assess if what they're setting is going to be meaningful and drive, the change and the impact that you guys are trying to invest in, or how much of it is just to check a box and to be able to report and disclose something and get an A on the CDP?
Scope 3 is not easy. So I actually really do think there's a lot of...
Lila, would you mind really quickly, just, sorry, briefly just going through scope 1,
broadly,
scope 2, scope 3?
Scope 1 and scope 2 tend to be things that you have direct accountability for in your footprint, whether it's manufacturing goods or your buildings and the energy that they use. Scope 3 ends up to do with your extended footprint, which relates to supply chain or even end of life or use of your product in consumers' hands. So just to go back to the 7th generation example, their scope 3 included the energy intensity of the hot water to wash your clothes with their detergent, right? Because obviously they're selling detergent to wash clothes. And so actually thinking about, could we get a cold water wash? How do we address that part of our footprint? So it is actually quite hard because it is outside of your control. Therefore, I do think that the kind of steps are to work with science-based targets, so work with science as a framework, and use a series of, I think now an incredible ecosystem of advisors, consultants that can go to the corporates in Fortune 500. You guys spend time with somewhat on your public equities, on our public equities team as well. Steps to having the right measurement of what you control, and then a understanding of what you can't control but you can influence, and then how those two things are ultimately leading to a commitment around a net zero pledge, right? So it does involve scenario planning, which would be the TCFD, and it involves ultimately R&D that's going to drive, your products to be in the hands of their customers, for example, more sustainable. But you guys, I should add in, unfortunately, it is still not even full disclosure on Scope 1, Scope 2. There's such a way to go, just base understanding. Now, the only thing I love, so private equity is great because you're in private companies, you sit in the boardroom, you can ask for the information, and you can make sure you get the information. So we actually run Scope 1, Scope 2, Scope 3 analysis across all of our private companies because we can get that information. Usually because these are software companies, in many cases, or tech-enabled companies, there'll be a big Scope 3 in the AWSs and in the Googles and in the, like this whole ecosystem of tech backbone, and the data centers that drive our technology ecosystem have a fair amount of Scope 3 emissions for anything that's software. So you just have to kind of understand that. But we can get that data at least on small companies, and as they grow, hopefully they'll be best-in-class disclosure. Really big companies, many business lines, very complex.
We invest in a lot of small to medium-sized businesses that aren't participants in the public equity markets, and therefore they have less disclosure. Maybe they're not as cognizant of the need. Maybe they don't have the staffing for it. Some of our businesses we invest in when they're short of capital, a little bit in trouble, need more resources around that. So while we're kind of encouraging them to have better disclosure, we also have to estimate what that might be. And I think it's really important to take a peek under the hood of what different companies and asset managers disclose and how they're getting to that number, because I think there is a lot of estimation and guesswork in there. And a lot of our companies that we see in the markets, they might have net zero plans. That's great, hooray, we're on the path, but what are the action plans underneath that? That's almost more interesting to me. And I think it's not going to be very long where just having a net zero plan is going to be sufficient, or having a TCFD report is sufficient. What are you tracking? How are you improving? What are your interim goals? What are you trying to do in the next 5 years? And how is compensation aligned with that? I think those are all really important questions that folks across all kinds of businesses are going to have to answer.
Yeah, I think that's exactly right. I think the only thing I would add is if you believe, this is a lot around the risk of greenwashing in many ways. If you believe, as I think all of us do, that sustainability is intimately tied with a company's ability to create value over time, one of the losers from greenwashing is shareholders themselves, who are being fooled, maybe willfully fooled into believing that a company is transforming when it's not, or is doing something that it's not. And so it's incumbent on investors to rely on the great work being done by TCFD, the Science-Based Targets Initiative, these groups that are trying to set very high, rigorous standards for companies to meet. But it's incumbent on investors as partial owners of these companies to ensure that they're actually doing what they're saying they're doing, and that it's not empty talk.
Am I right to think that there is a huge opportunity for a company and or companies to be able to provide tools or data and analytics around many of the things that you're talking to? It just seems like there's an imperfect solution set out in this space. And just curious if that might be an area
the market
to
is
innovate.
booming.
Yeah.
I mean, no, it's really, really important, but it's also right now we have a proliferation, so there's probably 200 companies who can, now provide some layer of analytics. But ultimately, over time, I think there's going to be a corralling of a set of partners that will give the software backbone, the validation, and the audit trail, because you're going to have auditors involved, and I think there's going to be tooling for that. I think there's going to be tooling for the commitments and how quality they are, because it'll be matched. This already exists in the market today. You can look at commitments and you can see trajectory, and the delta, if it starts going, like this, it'll be clear in a software tool that everyone could have access to, and ultimately this could sit in mainstream agency databases with ratings agencies or Bloomberg or what have you. So this is all going to be, it is available, it is growing, it is a boom market.
Right.
It's a cool place to work, and I think there's probably a bunch of companies right now that are going after this, and I think there'll probably be a corralling of support for a handful of really interesting platforms.
One thing I'll just add is that we've already seen the very, very beginnings of, I think, what will become a bigger problem a decade from now, which is companies, there's a Canadian oil and gas company that reset its base year. Realized it was not going to meet its targets, and so kind of in the dark of night, it reset, actually, instead of trying to reduce emissions 33% off of 2014, we're actually going to use 2016 as the base year, whatever it was. And I think right now it's very easy to make net zero pledges, and it's very easy to set these long-term targets. And as we get closer, I'm sure we'll see more of those sorts of divergences and a bigger role for some of these providers to play in helping all stakeholders hold these companies accountable.
Last question, and then we'll wrap. And again, it's a personal question, but I'm curious what advice you would give yourself, or maybe even give others that are thinking about getting into this space. And Lila, I think about your story that you mentioned, working down the street for a nonprofit well before Generations, and Priya, you making a switch to doing ESG, but not having, having done it before. Michael, same thing with you. You've worked both in the private sector, but also in the public sector. I'm curious what advice you might give the audience on making career pivots or changes at various points in your life. And while you're thinking about it, I'll just go because I'll give you time to think about it. For me, someone that had been in recruiting for a long period of time, specifically focusing in technology, I had to give up a fear of being unsuccessful in making a pivot into aligning a lot of what we were doing at our firm. And the only advice I would have given myself was do it earlier. Make the jump earlier. And sometimes you have to get over your own fears that are based in failure or ego. But I guess that's the only advice I would give myself is move earlier.
I think the value of, so this is not what high schoolers get taught, and it's really sad, but because everyone's taught to specialize and be exceptional. But I'm looking forward to the day we have the return of the well-rounded systems thinker in our society, in our politics, in our companies, in our financial systems. I think that the advice I always give is be well-rounded because you never know how it will serve you. And so therefore, even if it's done if it is in your day job, great. If you can find that, you're in a very privileged position, but it isn't always the case. And so find ways that you can be an influencer within your company or your organization, and if not, complement around the sides. That would be my advice. But I really look forward to kind of a world where a well-rounded individual is valued again, because I feel like our society is training exceptionalism, and oftentimes that's at some expense.
No bias being an English major.
No bias.
Exactly.
And having 2 young children.
I've been thinking about this sort of question because I'm doing alumni admissions interviews for my undergrad, and you see these kids. I mean, they're really kids who they want to be astrophysicists, and that's what they're going to do. And I remember being, 17 years old and going into college and thinking I'm going to be a neuroscience, academic and like do lab research, and that was not the direction that anything ever took. So, I had all these kind of like 5-year, 10-year plans and like blew through them, and now I don't even bother because I think the most important thing is to be guided by your values. So what's the kind of work that when you end the week and you're like, wow, that was really cool that I got to work on that. Like, what was it about that really got you going? And being in touch with that is probably the most important single thing you can do to think about a career move that's going to make you happy. And for me, it's a lot of interacting with people, a lot of exploring new topics, seeing a need and trying to meet that need. And that's taken me in all kinds of places and to all kinds of geographies that I never thought I'd be. So that's the advice I'd give myself, be open-minded and know yourself first.
I would say it's still early. It's hard to remember that 15 years ago, terms like impact investing or green bonds didn't even exist yet. And there's now multi-$100 billion asset classes. For someone just entering the space, I think all the jargon, the acronyms, the standards, it kind of creates this air that it might be impenetrable or that you're behind the ball. It's still so new. There's still so many companies, investors, folks who don't know, they want to change, they don't know what to do. And it does not take that long to come up the learning curve in a space that is still itself figuring out what it means and where it's going. And I think that creates a lot of opportunity, especially for young people who don't have long work experiences. This is an area where pretty quickly you can know as much as almost anyone in the field if you want to put in the work.
Great point. Well, we want to thank you for being an amazing panel for us. And I wrote this down, so I didn't miss anyone. But I just wanted to go down a list for sincere thank yous. At the Exploratorium, we just wanted to thank Amy Atkins, Billy Sarno, and Clay. Thank you very much for all your help here at the Exploratorium. I wish the audience could see what we're looking at. It's the Bay Bridge and
the sailboat that recently cruised by.
Exactly, and a very typical Bay Area foggy kind of day. From Hopkins, we want to thank Vicki Schneider, Dr. Jerry Burgess, Dr. Jen DeRosa. From Heidrick Struggles, Leah Randazzo, Marone Benti, Jeremy Hansen, Kristen Munoz, Brittany Bardo, Josh Annisfeld, Brad Warga, Maggie McGraw, and also want to thank Katie DeHaas. Thank you for joining us, being an amazing Q&A participant and leader. Also want to thank Ryan Rollins. Where's Ryan? He's in the corner. Ryan, do you want to come out and say a quick hello? I don't. All right. But Ryan and his crew are in the back, and they've been amazing to work with over the last couple of panels. So thank you for all the work on production and making this happen. Most importantly, second before we get to the panelists, but I want to thank everybody in the audience for joining, both here today. I know it's a rainy, crummy day. Everybody's coming back into the flow of what normal is with COVID. So thank you for coming. To our online audience, thank you again for joining us. We hope you check out some of our previous episodes. We had one on sustainable food systems, another one on conservation technology, and then our last one was on environmental leadership with Dr. Jane Goodall, Ryan Gellert, the CEO of Patagonia, and Lisa Jackson from Apple. Those are all available online on YouTube. And last but not least, we do want to thank again Lila, Priya, and Michael for an amazing conversation. Thank you very much. We'll be doing this again. Join us again, and thank you again for participating today. Take care.